I am so excited about tonight's event. I say that every time, I know, but I'm more excited about this event than most. It is number 29 or 30 or maybe 100 in a series of that we started back in November of 2019 with NASDAQ on rewriting your future with financial planning. Especially important during this month. This is April, Financial Literacy Month. And we want to make sure that we're letting our community know everything we possibly can share with them to help us build our wealth and build our legacy. And tonight we have experts here. We have not just great looking folks, but we have people that really know the subject. And I think you're going to enjoy hearing what they have to say and what they're talking about in the field of investing. This is Investing 101. I'm not going to talk about 102 yet, but let's talk about 101 tonight. 101 is going to try and get the folks on this call tonight, on this Zoom meeting, to a point of understanding that, you know what, there are things I need to do right now, not next week, not 10 years from now, but tomorrow at latest, tonight if possible. We're going to give you the contact information for the folks here, the three gentlemen here that do investing. And Kristen, thank you as well for joining us. But they are the people that you might want to follow up with if you hear something tonight that sounds like something you really want to do. Not to stay on this line too long because we have a lot to cover. Let me just begin by looking at my list of people I need to thank. First of all, let me thank Marvin Vasquez and MMUSA and his team for putting this program on. Without them, we don't know what we would do. And then there are people that come from Merrill Lynch and Prudential Financial and BNY Mellon and MBA Chic, and the Federal Reserve actually is going to be with us on Tuesday. So we're giving them a shout out real quick. And of course, NASDAQ and my fellow friends and family at the National Black MBAs, not just locally, but nationally as well. Thank you once again, everyone, for coming here tonight. I'm here at the purpose of introducing our moderator. I'm going to call him a dear friend because he responds when I call him, and that's what friends are all about. I asked him to come help us moderate this thing. He's usually on the panel. We gave him a new role tonight. But Anthony Shropshire is from Merrill Lynch. Anthony, I don't know what your title is in particular, but maybe you might want to say that. But he's way up there, folks. He knows the subject. He's got 100 years of experience in financial planning and management, and he's going to moderate the program for us tonight. So without any further ado, Anthony, thank you so much for helping us tonight.
Yeah, Chuck, it's really a pleasure to be here, and it's nice to be in the moderator seat and not getting drilled questions. So my name is Anthony Shropshire. I'm a private wealth advisor at Merrill Lynch. I manage a team of 10, and we manage about $900 million of assets and liabilities for private clients and their families and institutions. But today we have three fantastic presenters here, and I'm really excited to introduce everybody and then really kind of jump right into it with some really good questions. So the first panelist that I'll be introducing today is George Barnes. George has been with Prudential since January of 1988. He welcomes the opportunity to educate his clients on the importance of growing and protecting their financial wellness. He works hard to ensure each client is confident about their goals and is prepared for any unexpected challenges at whatever life stage there may be. So George, really excited to have you here today. Additionally, we have Carl, and I'm just grabbing Carl's bio here. Carl Bennett is the Director and Chief Financial Officer of BNY Mellon's Finance Group, providing the CFO, controller, and financial planning and analysis support across several corporate functions, including corporate strategy, corporate treasury, enterprise initiatives, finance, global client management, marketing, and communications. I don't know how he has enough time to do all this stuff. In this role, Carl serves as finance business partner and advisor, really responsible for operating plan development, management reporting, business analytics, and guidance to support financial target settings and performance management. And last but certainly not least, we have Kristen Myers, editor-in-chief of The Balance. Kristen is an award-winning journalist, producer, and editor-in-chief at The Balance. Before joining The Balance, Kristen was a senior writer at Yahoo Finance, host of Yahoo Finance Live, and one of the creators and host of A Time for Change, a weekly program that explores race, diversity, and inclusion in the world of business, finance, and politics. And so with that, what I want to do is really jump right into it. I'll start with Kristen. Kristen, would you mind just, give us a little background on yourself, but also talk to us a little bit about what investing means for you and how did you get started and really why is this so important to have this conversation today?
Yeah, that's such a good question, because you always want to know who you're essentially getting financial advice from. But I started out as a student at Penn, and I thought I was going to go into medicine. I was always told growing up, I'm a daughter of immigrants, you're a doctor, a lawyer, a disappointment. So I was like, all right, I guess I'm going to be a doctor. But then I failed at that. I decided I wanted to be a journalist instead. And I immediately actually started out doing financial journalism because I still love math and science. It's what I was always really drawn to. So started out at Bloomberg, reporting on oil and gas and essentially commodities, and then moved back to the United States. I was living in Europe at the time to doing that. And then I moved back to the United States and worked my way somehow back into financial news again after taking a couple detours in the politics and international news arena. So I've been now covering markets and everything to do with finance for the last several years now. And the more I get involved with financial news, with markets, talking about investing, talking about companies and earnings season and venture capital and interviewing CEOs and, a lot of different business leaders and also, political leaders that are really making our monetary policy, it really struck me how not diverse not very inclusive these communities were. And when I was going home and talking to my own parents, when I was talking to my girlfriends, I realized that there was huge knowledge gaps. And you have to keep in mind, I was talking to friends that all have Ivy League degrees, that are incredibly intelligent, are doing very, very well for themselves, making six figures, but they still didn't really know what to do with their money because no one had ever told them. No one had ever taught them. No one had ever really had these conversations with them. And it was frustrating to me because I realized that this is a group of people, just personally, that could really be generating huge amounts of wealth, not just for themselves, but also for their families, for their children, for their grandchildren, their great-grandchildren, and they're missing out on tons of gains that a lot of other communities, or not a lot of other, one main community is tapping into and has been tapping into for generations. And so for me, it's super important to have these kinds of conversations, to talk about investing, to make sure that everyone knows that investing is accessible to almost everyone. If you have an extra $5, $10 in your pocket every single week, you have enough money to invest. Everyone can start somewhere. And to answer as many questions as possible about how to get involved in investing. Because truly, I think that you're never going, I'm very, very clear on this. You're never going to save yourself into wealth. It's just not really going to happen. You have to invest yourself there. And for most people, you're also not going to sell your time, i.e. through a job, into wealth either, right? Most people aren't making $10 million a year. And so investing is that vehicle, I think, to really financial freedom and to really generating wealth, not just for your family, but for generations to come. So that's why I'm so particularly passionate about chatting about it.
That's awesome. Thank you so much, Kristen. George, can you talk to us a little bit about investing and what it means to you?
I think that, to me, just to kind of keep things simple, investing is the way for you to pad your future. If you're driving a car, it's the air in the tires that gets you from point A to point B. Investing is something that you have to be aware of. You need to take your time, but you need to do it. Investing is not the boogeyman under the bed. It's not the skeleton in the attic. It really is your friend that you haven't got to know. So to me, it's just a matter of you getting to know this friend and taking advantage of that friendship and using it to move along in your life. I have used this analogy on many occasions that we all have been in a room where it's dark, and then we have to get from point A to point B. Well, we're concerned because we don't know what's in the room. All we need to do is turn over to the right or to the left and turn the light on, and then we can navigate. So now knowledge gives power, it gives direction, it gives purpose. And so the more that you learn, the more that you know, the more that you're going to be able to do. So investing, to me, is really about you taking time to, first of all, admit that you don't know and that you're willing to do something about it and act on
That's great. That's great. Carl, same. What does investing mean to you, and why is it so important?
Yeah, and I echo what Kristen and George have said. I think we all probably share some commonalities from that standpoint. What I would add, though, is that for me personally, it's about empowerment in a way, not only for our community, for our own families. I think about it in the sense that as we grow, as we look to put cash to work, I agree that you can't trade your time for dollars. There's just not enough of it, and so the way that I've known how, and people have different risk tolerance, I'd say, and risk appetites, and so it may steer them away from particular asset classes like stocks or bonds or whatever. But there are so many different areas or asset classes that it's a matter of a comfortability for people to kind of get tied on. And so for me, it's really about just trying to drive wealth, to drive generational wealth, and to get a focus that's just beyond, collecting dollars and leaving it in a bank account where you earn near to zero returns, and so it puts you in a bind from that standpoint.
Right, understood. So, it's pretty scary out there right now, right? We have interest rates. It feels like the Fed is not necessarily our friend anymore. We see inflation levels spiking at unprecedented levels. There's geopolitical issues out there. And so, and there's just a lot of market volatility at this stage in the game. So my question, I guess, for you, George, is should I invest now or should I wait? Like, how do I think about all this stuff? I mean, it always seems like every time I look at my phone or turn on the news, there's some kind of bad news, right? So should I wait?
I grew up in Newark, and we used to jump. Guys did jump double dutch, right? And so if you remember double dutch at all, you've got two people jumping rope and you've got the one person getting in. The one person getting in is leaning back and forth, leaning back and forth, leaning back and forth. And they're trying to time it so they don't get tangled up in the rope. I think people do that when it comes to investing. They're leaning back and forth, trying not to get it entangled, trying not to buy too high or buy too low. You just got to get in the game, right? Investing is about getting in the game. But I want to preface something. It's not just getting in the game without a purpose. In our practice, we stress goal-oriented investing. So therefore, we're not trying to catch a return, but we're looking to measure where are we in respect to the goal. So that just because the market is up or the market is volatile, that's not really an issue depending upon what the goal is. If the goal is retirement, if the goal is college planning, the goal is your second home, and that's not for 8 years or 9 years or whatever it is, then we've got a strategy that'll get you there that is not necessarily tied to whether the S&P or the Dow or whatever the indexes are up or down. So strategy is key to being in the market. So it's not just being in it, but it's being in it with a purpose. And so I would stress to you, yes, it's important to invest, but make sure that that investment is tied to a goal. So therefore you're not going to be fooled by fool's gold to say, oh, the market's up, I made money. Or now you're in your feelings because the market is down. The market does two things real well. It goes up and it goes down. It does that very, very well. It's been doing that for a while. Right? What you want is a strategy. How you manage that over your specific, and the word is time horizon. What's that time horizon? So invest with a purpose, but yes, do that. So that's how we look at it. That's how we design it in our firm.
Right. George, I say the same thing to our private clients. I say it's all about time in the market, not timing the market.
Exactly. Yep.
kind of old cliche, right?
Yep. Old is good. This is great.
Yeah.
Old is good. That's why I got
Yeah,
gray
no
hair.
doubt. No doubt. Now, Carl, anything to add to that?
Yeah, I guess what I would say is, and George hit it spot on. It's all those things are things that people should be thinking about. I think when people are just investing for the first time, they're new to investing, they try to find the perfect investment, and in many cases there may not be necessarily be a perfect investment, because any investment can go awry, can do well or not do well. Because there are a number of factors, you listed some of them at the outset, that can impact how an investment may perform. And so for even folks in my family who might ask me, I generally start people who are starting out just to suggest to them that, look at some indices, like, look at the S&P 500, look at the NASDAQ 100, look at some things where you're not necessarily focused on any one individual stock, that there are any individual asset class where you're overly exposed. We have too much exposure in any one area. And if I were to focus someone around, let's say, index investing or investing in the S&P 500, you have essentially 500 of the best stocks that are out there that sort of comprise that index. And so it gives you a sort of natural diversity. If there's a stock within that index that's underperforming for whatever reason, they get taken out and they get replaced by something else that's meeting the criteria to be in that particular index. And that's generally how the indices work. And so from that standpoint, I would suggest to people that you get natural diversity. You get almost a portfolio manager, in essence, who is essentially rotating out and rotating out the bad performers, rotating in the good performers, and over time, with the right time horizon, with the right goals in mind, it puts you on a platform to achieve your goals over time. And so that's generally the idea that I try to focus people on when they're starting out. Don't be afraid of and be so focused on any one individual company, but just as George said, just get in, just start somewhere and then watch it evolve thereafter.
That's great. Now, I really appreciate that. And just to even back it up, since this is Investing 101, Kristen, would you mind just educating us and giving us, high level differentiation between the difference between a stock, a mutual fund, and an index fund? Because, sometimes people hear about, these things almost in an interchangeable way. I heard Carl talk a little bit about indexing and things of that nature. Would you mind just educating us?
Yeah, this is really good. And obviously a nice little plug. Everyone can also go visit the Balance. We've got like a very extensive terms library. I'm talking like tens of thousands of terms. So you can literally but you can literally type into the search bar almost anything, and we will likely have a definition there for you and break down and explain it for you. But so very high level, I think you mentioned, so stock, right? That's essentially you're buying a piece of a company, right? Whenever you go out and you buy a share or one stock. When you're buying an index fund, which is what Carl was mentioning, what you're essentially doing is you're buying a piece of what is tracking a basket of companies. So if you're buying like the S&P 500, that index, essentially that's the 500 biggest companies in the United States. It's also a nice, really quick snapshot of like economic performance of the US economy, right? Because the 500 biggest companies, and they spread and span various and different industries. Now, you don't have to buy an index in terms of the S&P 500. There's plenty of different indices that will group different companies based on various and different things. And then I think you also mentioned mutual funds. That's essentially you pooling money together and investing. This is, again, very top level, but again, with others, but you can purchase them like shares. So what we're essentially highlighting here is that there's very many different ways for you to get involved in investing, right? You could do certificates of deposits. You could buy ETFs. That's like a basket of goods or securities that you can purchase. So there's many different ways that you can get involved in investing. That's just beyond you buying one share of Nike, one share of McDonald's, one share of Tesla. You can buy treasuries, you can buy bonds, that can really be tailored to your appetite for risk, essentially, and also for your goals, and even also your age, how close you are to retirement. My investment portfolio is likely going to look very different than the portfolio of someone who is 70 years old. I can afford to take on a little bit of risk, actually a lot more risk. I'm very risky when it comes to my investments because I know we talked about time in the market. I've got a lot of time in this market. I'm not looking to retire. Actually, I am looking to retire tomorrow, but I actually would love to retire tomorrow. I will be honest, but I'm right now planning for the long term. I'm going to be riskier in my investments. So things like bonds, I'm not really looking at them as much as I'm looking at equities right now. So again, these are all based upon your personal financial goals that you have, your risk tolerance and appetite, and even what your own financial snapshot looks like. But again, there's so many different types of investments that you can make. So always be sure to, do a little bit of your research, especially if you're doing some of that investing on your own.
Right. Yeah. Go ahead, please, George.
Yeah. I think, Kristen, you are spot on when you talk about risk tolerance. And I think that if you marry risk tolerance and novice, you've got to make sure that you are in the right church, if you will, right? Because if you are new to the game and you say, oh, I want to be in crypto. Well, hold on. Did you just say you're new to the game? Yeah. Oh, well, I know a friend of a friend who made, $10,000. People, please don't fall in love with the fame, stay in your lane. If you're new to the game, right? It really, really is important that if you are new to investing, that you don't fall in love with everything that has just come out, that you find an advisor or advisors that understand you where you are and go back to your goal. I think that risk tolerance is really misunderstood. And I think that in the beginning, when you start doing your investing, you should make sure you understand your own self, like old school, to thine own self be true when it comes to investing. Make sure the person that you are working with, that they understand you and they understand your goals and where you're going and what it is that you're trying to accomplish. And then the things that we talked about, and whether it's an ETF or whether it's mutual funds or whether it's stock. Charles Schwab said in a book that I read a long time ago, if you're going to buy a stock that you're interested in, right? Oh, I want to buy Tesla. Probably not going to happen, right? But depending upon where you are. So again, I would say if you are a novice in investing, your risk tolerance really needs to be in line with your knowledge, and then you make decisions along that line.
I also want to quickly jump in and just quickly add, I feel like we don't talk enough about this, but you really need to check your emotions at the door when you're going to be investing. I see so many people continuing to throw good money after bad because they're so insistent upon an investment that they're making. This is not gambling. This is not betting on a horse. This is not about a feeling that you have or Johnny down the street that you heard talking about some kind of investment in a company you've never heard of, couldn't explain, don't understand, and you want to put your money into it. That is such a terrible idea. You have to be able to know when an investment's just not working out for you. Maybe you liked it. Maybe you like the company. Maybe you really believe in the CEO. I'm really thinking about the Tesla owner. The Tesla right now is a quick one because Tesla investors are very, very fanatical about it. But you really need to understand, like, if this company is not doing well, you need to exit out of that position, and there's nothing wrong with it. The only name of this game is make more money. And it doesn't matter how you do that. It doesn't matter what you're investing in to do that. If you're making more money, that is ultimately the goal. So you can't get too tied to a particular investment, stock, company, whatever it is that you have. If it doesn't make you money, it is no longer your friend. So I always feel like you really need to make sure that this is not something that you're going to attach a lot of your emotions to. And it also works on the flip side. If the markets don't do well, and sometimes they won't, you can't all of a sudden get scared and decide to exit, because I guarantee you're going to miss the upswing and the gains on the other side. And then you're going to be sitting there saying, damn, I had Bitcoin, and let's just say Bitcoin was your investment, and you sold it because it went down to 5,000. And then it went up to 70, and you're really looking upset. And now you're trying to chase that. Now you're trying to buy in at a high to try to get back into the party. And now Bitcoin's at 41, and you're always going to lose if you do that. If you become an emotional investor, you're always going to be trying to play catch up.
Right.
No,
Right.
all this stuff is great. Carl, did you have anything to add?
No. I was going to point out that generally, and Warren Buffett used to say this, like, his philosophy was always to be greedy when others are fearful, and fearful when others are being greedy. So he almost, when people are in the market, and the market is going through any sort of dislocation and let's say declining for whatever reason, everybody runs for the exits at that time. And then when everybody does that, I mean, obviously, if you're selling when the markets are declining, you're not making money. And so, his philosophy was, when the markets are declining at that, in a rapid fashion, or there's really any dislocation of that sort, he's looking for opportunities. He's looking to be doing almost in a contrarian way. He's entering when others may be exiting, and then when the markets are frothy, when it's really at elevated levels at its peaks, those are times when you probably could be taking profit. So I think people have to understand the reason why they're entering into a position. If the fundamentals of that they looked at when they entered that position is still the same, then they with natural volatility, you're going to see ups, you're going to see downs. But if the investment itself didn't change, chances are it's going through a cycle, and in essence, you don't necessarily want to be exiting at the wrong time. And so there's a philosophy there that people just need to be thinking through around just how assets and asset classes sort of go through the investment cycle in terms of when they trade up, when they trade down, and people just need to be careful about trying to time when they get in and even when they get out.
Yeah, and just to add to all that stuff, I'll say it from my practice as well. I try to tell people we're never selling equity unless we're swapping it for more equity or to harvest losses to offset gains. And the time, right? We talk about timing of selling. The time that we decide to liquidate or sell or get out of the market is predetermined up front. We're having a conversation. You're 40 years old and you want to retire when you're 62 years old. That's about the time when we start to think about de-risking the portfolio. But by and large, we're going to be long-term holders of equities. But one of the interesting things that I found, from being in this business for over a decade and managing assets for private clients, is that the market kind of feels like it goes up like an escalator, right? And then it comes down like an elevator, right?
Yeah, right.
And so, one of the things that I wanted to ask George about today, while we have everybody, is just, a tactic about a dollar cost averaging and how to just think about, do I take all my money and invest it all in once? Like, how do I think about this stuff? How do I back into a strategy based on my time horizon and liquidity?
Well, listen, again, based upon the fact that this is Finance 101, dollar cost averaging, what it does, that it allows you to take a small bucket of money and invest it in increments, 12 months out of the year, 12 times they take a debit out of your checking account and you buy into the market, whether it's high or whether it's low. And then hopefully the average purchase of that is going to be better for you over time. And if it's done correctly, then you actually have built a portfolio and you can actually move that out and do something more creative with that. But ultimately, dollar cost averaging helps you not to buy into it by taking your lump sum and then immediately the market goes down and now you're narcissistic. You think that the market hates you, right? Because you put all your money in and now you feel bad. And that's why I never put my money in, because the market doesn't like you. No, again, market does two things real well. It goes up, it goes down. You put all your money in, you put it in on the day it's a down day. Now you got issues. All right. I think, like Kristen said, now you're in your feelings, right? Because you put it in and you see it devalue, and then you become fearful, and then you take the money out. What dollar cost averaging does allows you to take smaller buckets of money and purchase a little bit over time. And then again, that strategy of dollar cost averaging helps minimize some of the angst that people have. It helps minimize some of the exposure that you have to market volatility. So it is one of the better known strategies. And whether you know it or not, you're doing that 26 times a year. If you're invested in your company's 401k, you're buying into that market twice a month, right? And you have the ability to buy at highs and lows. And so again, and I do want to also say this, most companies offer an analysis software, a goal maker that does your risk tolerance. Don't poo-poo that as I don't want to take my time and figure that out for your qualified money. Take time to use that. That helps you to get familiar with the different terminologies. Like we talked about risk, we talked about asset allocation, we talked about rebalancing, right? All that stuff is explained in those tools. So take advantage of that.
So one of the things that I find that some folks struggle with is things like having student loans and credit cards and like minimums on investments and things of that nature. So Carl, like, how much money do I need to have before I can really start thinking about investing?
Yeah. So I feel like if you have $5, if you have $10, you can be investing. Like, there really is no minimum as such. I think about this in a way that suggests that you always, and I try to get people into the habit of, as George alluded to, of just continually investing. So even if I had $1,000 to invest, I wouldn't necessarily, me personally, wouldn't go in and put my $1,000 in all at one time. Now, some might say, well, it's only $1,000 and it probably wouldn't matter. I want to develop, I want to get into that habit, particularly now when a lot of platforms are allowing investors to actually purchase positions, or whether it's in equity, in whatever, in equity assets without a commission. So you can buy into positions for free. If I have $5 to invest this week, $5 next week, 20 investments of $5 gets me to $100. And so I want to get into that habit of investing over time continually. To the point of dollar cost averaging, or getting into a position gradually. It eliminates a lot of the volatility, or the impact of a lot of the volatility. So you're not ending up buying at the very peak. You may not be buying at the very bottom either, but because none of us are, none of us really know exactly where the market is going to trade at any one point, irrespective of what people say. We're really following a pattern that allows us to enter into a position that allows you to continue to invest continually over a long period of time. And with the impact of compounding, that's where you really start to see those returns really add up over time. And if we've done anything in our look back process, if you do your regression analysis and you look back to see how markets have performed over time, if you take a 10-year block, a 12-year block, 15-year block, you're generally going to see returns, double-digit sort of returns, over an extended period. So, to my mind, that's where people should be. Just get into a habit of even just small increments. Just if they have it, just put it in, and make it a habitual thing.
I will say, however, as much as I know we're here to talk about investing, and obviously all of us here are advocating for investing, not everyone should be investing right now. That's just the reality. If you are saddled right now, so we talked about inflation, right, is going up. That means borrowing is getting more expensive. And if you have $50,000 of credit card debt or high interest debt right now, and you're barely able to crawl out of that hole, now is not the time, especially with those interest rates going up, to try to take that spare money that you have and to throw it in the market. It is always a numbers game. If the
Sure.
return on the investment that you're going to make in the market is less than the interest you're going to have to pay on that credit card or whatever else kind of debt that you have, is probably better that you try to pay off some of that debt. Now, I'm always very big on trying to do things simultaneously. I personally have savings goals that I'm doing right now. I've got a car note, so that's my debt that I currently have. I'm still waiting on Biden to cancel my student loans, so I'm holding on to hope on that one.
Right.
But my main debt right now is my car note, right? But that's a very low interest, loan for me. So I'm still very much actively investing. But again, if you have high interest debt right now, and it's a large amount, and you don't know how you're going to get out of that debt hole, that debt trap, now is not the time for you to take that spare $500 every month and to throw it into the market.
Yeah.
I think that you really want to make sure your debt's manageable before you decide to get risky with investing.
So, Kristen, I have a question just on that topic, and then Georgia, I'll definitely come to you. How should I expect my investments to perform? Like, are there any historical factors I should consider when investing? Like, when you say, right, you're talking about spread capture opportunities, right? If there's an opportunity to make more money in the market versus pay down the cost of capital, right? I understand that piece, but what's a realistic expectation if my credit card is at a 18-month APR of 3%? Should I invest then? Like, how should I be thinking about?
If your credit card, well, I need you to tell me what credit card you have at just 3% APR. You're really hiding the information from us, Anthony. If you got credit card,
it's those balance transfers. It's those balance transfers.
You gotta tell me where you're getting these kinds of loans, because
this is 101. This is 101.
I gotta make some calls. Okay, so I will say this: historically, the stock market was going to yield you returns around like the 10% mark. However, last year, the market did 27%, was up 27%. The S&P 500. There's also been years where the market is not doing that well, right? And so I don't want anyone to think that if they're not making a 10, 15, my dog's here, he's agreeing with me. If you're not making a 15% return on your investment portfolio, that your whole portfolio, you need to just throw it out the door. I do need to, like, everyone caution you on that. If your investment, however, is only making 0.5% and you're not in a CD, you're actually in equities, then you're not doing that great, right? You're way under what the historical averages are. But if the market's up 8%, you're doing pretty good. And if in a year like 2020 or 2021, your portfolio is up 25, 30, 50%, depending on what you put your money into, then that's just that year. You can't expect those kinds of returns every single year. So again, I mean, I think honestly, what is a good return on your investment? I think ultimately the answer to that is a good return on your investment is one that is going to get you to your goals at the end of the day.
Yep.
If what you need to get to your goals is 5% every single year, and you're tracking along with that, then you're doing what you need to do. If you need to be making 10% and you're only making 2%, then you need to make an adjustment. Your goals need to be adjusted. Something needs to be adjusted along the way. So it really is a personal, I think, answer. But I mean, if we are to put some numbers on it historically, yeah, about 10% is how the markets do.
That's great. And then George, I know you said you wanted to add something.
I know that this is investment 101, but the planner in me says that I've got to bring this point in. I understand that there is a wealth gap, for the Black and Brown community in particular, and I understand the need for us to be in the market and investing. I am of the mindset, in order for that gap to really be closed, right? Because we're talking about us being having the ability to invest. But I think that insurance is going to be the way that helps that out. I have a wife, I've got 3 kids, I've got a special needs son. I got to make sure that I'm insured enough because my wife is going to take all that I have if I pass her. And if I leave it to my kids, they got to start paying that out. But if I have life insurance and I leave that, that's going to go to them tax-free, and they're going to have a leg up. And so people being properly insured for the right amount, I'm not talking about kind, but if there is a quality of life that your family or your loved one, your partner has, you have a right to make sure that you're protecting them with insurance, and not just, back in the day when they said, George, I need you to help me get some insurance. Can I get a $25,000 policy? No, I can't help you with that, because that's only going to help you. But what about your wife and what about your kids?
Yeah.
So I just say to you, I know the bulk of our time we want to talk about investing, but please, pretty please, with sugar on top, make sure that you indemnify the quality of life of those that you leave behind. And then lastly, make sure you have a will. Make sure that you are able to speak from the grave. Make sure that you're able to speak peace to the foolishness that happens because you've got a cousin or a sister or a family member that thinks that tchotchke that you have is really worth more to them than it is anybody else. Organize yourself, write it down, have an attorney write it up for you, and have a document. There's so many other aspects to it, but I am beholden to my convictions that a will is one of the main financial instruments that people are missing. And it doesn't matter what kind of degrees they have. Their will, they haven't updated it in 15 years, and the kids are going out of college, and they're not even speaking to their brother-in-law anymore. So again, insurance and proper estate planning or wills, I think, is critical. And I think it's foundational before you even get to where you're investing. I believe in risk management, and that you have to have that piece done. And once that's taken care of, then you can move into the investing. Because I just see that as complementary. So I gotta say it.
Yeah, no doubt. You're speaking nothing but truth, George. And I'm feeling like some of the things that we're starting to dive into, and it's hard not to, because all this stuff is interconnected, right? Think about your balance sheet. You think about savings and cash flows and investment management and credit and lending and estate planning and philanthropic giving and risk management and asset protection, and all kind of comes together.
And a budget. If you don't have a budget, do not start investing. Like that is like literally, honestly, everyone, what we're talking about here this is a house, right? And your budget, for example, is going to be the foundation of that house. And then you're going to build the first level, and then the second level, and then you're going to put the roof, the windows. Maybe you're doing real well. Now you decide to build a pool out back. But the thing is, this is how you really need to start thinking about your financial picture, that they all are starting to build on each other. You can't put on a window on a wall that's not built yet. So you really have to, really start thinking about this and moving along this track so that you can really build that wealth. And then when you start a family, you could start thinking about making sure that they can, and I really need to be clear on this because, and I like to say this stat all the time, Black folks fall more out of upper class into lower classes than any other demographic. Black folks will inherit wealth, and within that same generation will lose wealth. So it's not just enough for you to say, I'm going to invest and build my nest egg. You need to start asking yourself questions if you're married, if you have kids, or if you have family you're trying to leave money to. Can my kids pay the taxes on the house that I'm leaving them? Can they pay the taxes on the inheritance that I'm giving them? You don't want to just leave your children with problems, with bills. You're trying to leave them with wealth that they can use to make their lives easier so that they can make more money to make their children's lives easier. And that's how you really keep the train going. So it's not just about investing. It's also about making sure that you're really dotting those I's, crossing those T's to make sure that that wealth maintains that family, your family and your structure unit, not just for now, but for generations to come.
Yeah, wealth protection and financial discipline is sort of what I call it. You have to have that financial discipline, to make it all come together in the end. So I couldn't agree more.
Yeah, and then Carl, I was actually just going to ask you, because we're on this like intergenerational conversation that's kind of dovetailing. But I also want to make sure we keep it within the constructs of Investing 101. When we start thinking about next generation planning, a lot of folks have a lot of questions about children. When do I talk to my children about investing? When do I start to think about educating? How do I talk to my kids about this stuff? Many people on this call are parents. How do you think about relaying the good information that you have to children and younger folks, and when's probably the best time to start having those conversations?
Yeah. So the good news is that with my own children and even others in my family, kids in my family, like I want to expose them to financial markets, to finances as early as possible. I mean, it can be as easy as inviting your kids to work, or bringing the kids to work on bring your kids to work day. Now, I happen to work in financial services. Everybody may not necessarily work in financial services, so it may not necessarily fit the bill for each person. But if you know anyone who is involved in financial services, anybody who might be versed on whether it's and it doesn't even have to be finance. It's just really getting an exposure. I watch CNBC all the time. I have it on in my house. Sometimes a transaction is happening. I will bring the kids in and I explain to them, what does this mean? What does it mean when one company takes over another? What does it mean to be an owner of a company? So it's really exposing kids to just whether it's the jargon or just the space as early as you can. There is nothing wrong with bringing a financial professional when they come to talk to you about life insurance, about a financial product, of having the kids there at the same time that could be listening, or just sharing some of the information with them. So the exposure, to me, the exposure at an early age sometimes will leave an indelible mark in the minds of in young minds, which will make them want to seek more, which will make them want to learn more, seeing the benefits of what it means when an investment comes together, when something happens in the marketplace that they can see the impact, how that may impact their own lives. So it's really just a matter of sort of being inclusive, including them in the conversation, even if you think they may not necessarily understand every component of a discussion at that point in time.
No, I totally agree. Great.
Oh, sorry. I just wanted to say, if you want an age, it's 3. Studies have found that children can grasp basic money concepts at 3 years old, and that money habits are set by the age of 8. So you got to start them when they're young, because it will inform the financial decisions that they will make when they're older. And if you teach bad money habits when your children are young, these are things that they're going to have to undo when they are older. And it just makes things more difficult. But I think Carl's point is really great. You just include children in everything when it comes to making money. Involve them when you go grocery shopping, give them an allowance, make a budget for them. But yeah, the age is 3. So if you have a 3-year-old, a 4-year-old, they're old enough to understand money.
Yeah, no, absolutely. And one of the things that I've found personally that has worked, when my kids get, $5 or they get $1 or $2, I'll ask them if they want to spend it or if they want to invest it. And I'll let them know that they can have that money, make money. And I'll take the $1 from them and I'll just transfer $1 into their investment account. And so they actually have accounts, and we talk about the stocks that they own and things of that nature. But I think that the big picture of it is just like having that conversation and keeping them involved, just like you guys are all talking about. So,
Anthony, there's a good game, I think, that young kids that I've tried this before, that they're really interested in, where and it's sort of an idea around compounding, where you say to them, if I give you a penny today and double that penny every day, even for 30 days, versus me giving you $10 today and you just have $10 and that's it. which would you take? And so you go through the exercise and say, I'll give you $10 an hour, or I'll give you a penny now that you could double, every day. So on day 2, that penny is 2 cents. On day 3, it's 4 cents, and just do that doubling all the way just for 30 days. And so that exercise, they get so interested. Well, it's math, and it's kind of fun math in a way. And then, and so that gets them started. And then, you show them the $10 that's sitting over here,
Yeah.
do the computation, and then show them the difference. And they'll realize it. So it starts to connect the dots for them, even at that.
That's interesting. Carl, is there any way you can get us access to that? I bet, I know I personally love that. I'm sure a lot of people listening and will like to know the name of that game.
Yeah. I'll follow up with you after and connect you with it. But it's really almost like an Excel spreadsheet that does it.
Gotcha. And I bet if you take that very same concept and explained compounding of debt, you could probably learn a lot of lessons that way as well. Right?
Exactly right.
So George, you've been talking a lot about this like liability driven approach to investing, where you're matching people's goals with portfolios and strategies, in order to maximize the probability of success. So could you just give us a little bit of an understanding of the difference between a financial planner versus an investment manager?
So a financial planner typically is an individual that is going to provide you with a document that covers your risk management, life insurance, disability, long-term care, give you some tax advice, talk about your interests, talk about your retirement plan, talk about your college goals. So it's going to be very comprehensive. And then he or she is going to have basically an implementation page or pages that says, here's the timing of when you need to do what you need to do, and this is what's important. So the financial planner typically is going to provide you with a document of how to execute the goals in all the financial areas of your life. And even addressing under risk management, talk to you about, in some plans, people cover umbrella policies and auto insurance and homeowners and all that stuff. So it's comprehensive. Now, when you talk about a financial advisor, they may focus primarily on what I'll call assets under management. They may focus primarily on how to get you out of the blocks and to cross the tape in a specific area of focus. And they may do that in various ways. At the beginning of our conversation, we talked about ETFs, we talked about stocks, we talked about mutual funds. So that financial advisor may use investments as their chassis to get clients to the goals that they have. Some of those advisors, they may dabble and do a little bit more of the comprehensive stuff too, but their main focus is really the management of those assets and tying it to the goal that that client has. The financial planner is going to provide a document, and they may switch hats after the document is done and become the financial advisor. But traditionally, the planner is going to provide a document. The advisor can provide a document as well, but they're going to focus more on the assets under management and how to get you, again, out of the blocks and across the tape.
Now, that's a whole lot of stuff. And, when I look at my phones, everywhere you look, you see, a lot of different places where you can set up accounts, Charles Schwab or Robinhood or, TD or Merrill Edge. Kristen, how do I actually open an account and buy a stock or what do I do this? Yeah. Is there a recommended place? Is there any place that you can leave a charge on? I have a feeling you have some expertise in this.
All right. So I'm glad we are touching it, because I think a lot of people might be like, okay, great. I'm with you guys. I'm understanding the emotional piece. I've done George's meditative, stance. I know myself, I'm in alignment. Now, how do I do this? So as Carl was saying, you really, as little as $5 is all you need to invest. Now, where you should start investing is a very good question. Personally, I hate complication in my life. I'm not a person that wants to have 15 investment accounts that I'm going to manage. So for myself, And it's I think a piece of advice that I actually think is helpful to other people. I actually went where my 401k was. Now your 401k might move. I know that I'm going to have many other jobs after the one I'm currently in. We millennials never stay in one place for too long. We're not in one place for 30 years. But I think that if you have a 401k account through your job, and I think most people, that's really where they're primarily having that retirement account, I would say just open up an investment account there at that same, so if it's Fidelity, then fine. Then you can look at your Fidelity account. You can see your 401k, you can see your investment accounts. If it's Charles Schwab, then it's Charles Schwab. Because once you get into the habit then of looking at your investment accounts, you're making those consistent contributions to your investment account. It's going to be something that you continue to look at. Whereas your 401k, you can afford sometimes you should sometimes do reallocations in your 401k, but this is 101. You can more set it and forget it, your 401k, more than your investment portfolio that you might be a little bit more actively involved in. So that's where I usually like to just start. Where do you already have an investment account open? If it's a 401k, an IRA, for example, where are you already investing for retirement? Once you've done that, you have to fund your account. So they make it very, very easy thanks to technology. You can literally link your bank account to your investment account. You can make the decision to have that account funded on a regular basis, whether that's once monthly, twice monthly, once a quarter. You can decide how much money you want to have put into that account. And once you do that, depending on the type of account that you have, the type of brokerage account that you're with, will determine the kind of investments that you can make. If you want to invest in cryptocurrency, for example, Fidelity is not going to be able to offer that service for you. You can do that more through Robinhood, although I will say Robinhood's not actually a wallet. I'm getting off course. Cryptos is a whole different beast. All I'm saying is that every different brokerage firms will have different offerings. I think most of the main brokerages that you mentioned will have most of those securities that most people will probably tend to be looking at and investing in. And so once you've opened up that account, you can quite literally start then searching for the stock that you want to buy. I think for someone who is new to investing, stock picking is not really where you should be going for. You should really start sticking with your index funds, your ETFs, investing in stuff like XLK if you want to invest in tech, XLU if you want to go for utilities, really start doing baskets of goods. It takes a lot of the pressure off of you trying to have to think about, is this a good company that I want to invest in? And it takes the pressure off having to look at the fundamentals of one individual company. And it allows you to invest far more broadly. And it's also a really great way for you to mitigate risk as well. You don't have as much risk if your portfolio is a little bit more diversified. And then once you've opened up that brokerage account and you've funded it, again, I really think you really just need to make sure that you are consistent. And again, I think that if you can afford it, if you can make it a part of your budget, make sure you're funding that brokerage account consistently every month, ideally. And so every month, make sure that you're making those investments in dollar cost averaging and purchasing an ETF, dollar cost averaging and purchasing one of those index funds. And then you can honestly just watch that nest egg grow. And it's very exciting once you start doing it. And honestly, I think once you start making investing a part of what you do every month, right? And I'm very big on paying yourself first. Once you get paid, like you pay your rent, pay that brokerage account. And, maybe you start off at 50 a month. You might realize you can actually start doing 100 a month. Then you might get to 1,000 a month. And then if you're really lucky, then you're doing 5,000, 10,000 a month. Our wealth is growing, right? We're making more money. We're able to fund our accounts more and more and more. And so that's how you're really going to be able to start off with 5 and end up with thousands and hundreds of thousands.
Yeah. And just to add to Kristen, and I have a question for you, Carl. I really try to focus on the inputs for myself and for my clients. So if we have a time horizon that's set out, and let's say it's 20 years out, and we discuss the fact that I need to save X amount of dollars in order to get there with some basic capital markets assumptions, it's my job to fund my account on a consistent basis and let the market continue to do what it does. But for me, I don't really care too much about, what the actual performance of my accounts are, And I actually care a lot more about how much I saved into those accounts in conjunction with that. So just something to think about, because you can control how much you save, but you can't control what's going to happen in the market on any given day. But we've been talking a lot about equities. We've been talking about index funds. We're talking about stocks. We've been talking about like equity related mutual funds and things of that nature. Carl, would you explain to us what a bond is and what purpose does a bond or fixed income serve in a portfolio?
Yeah.
Because I think
Yeah.
that's something I haven't touched.
Yeah. So a bond is sort of the fixed income side of equities, so to speak, and for the people who think in terms of equities and fixed income. A bond is essentially a firm looking for funding. So if you're a company, you're looking for funding from the market. An investor is in the market is essentially loaning you, or you're selling that person a note. They're making a loan into your company that you're telling them that you're going to pay them an interest on. So as an example, if I am Apple, let's say, and we're looking to build a new, put up a new structure in our corporate headquarters, in our corporate campus, and we want to fund that not with equity, by selling more shares in the company to dilute maybe existing shareholders, but you want to fund that somehow. You may issue notes or issue some fixed income securities that you would offer to the public, to the market, and people would come in and essentially buy those or invest in that note or in that fixed income instrument for a return, for let's say 5%, 10%, whatever the case may be. In the structure of how in terms of the comparing an equity versus a bond versus a preferred equity, in that pecking order, the bondholders typically are going to be towards the higher end of in terms of priority of getting their monies returned to them before the equity holders are, in the event that that company should dissolve for any reason. And so some people may offer from time to time to invest in a bond, do bond investing more so than equity investing. Bond investing has essentially a fixed return, so you know exactly what it is that the interest is going to be paying on that bond, versus equity investing. You're often relying on in some cases, an equity paying dividends, but in most cases, you're relying on the price of that equity, the value of that equity changing for you to earn over time. So it all depends for an individual, which, again, based on their risk appetite, based on what it is that they would, based on, how they want to balance their asset classes, where they're invested, in their time horizon, whether they're more heavily invested in equities and fixed income, even in other asset classes, alternative investments, real estate, whatever the asset class is, there can be varied, and we always recommend a broad diversity of investments. But fixed income is definitely part of that equation. And again, depending on risk appetite, some people actually prefer that versus equity investing. But again, it depends on your time horizon and where you are, how close you are to retirement, et cetera.
So I have a question really about vehicles, like how to get there. George, could you help us to make a determination? Is there a better place to invest, or do like I've had people say a Roth performs better than a 401k, or an IRA performs better than a brokerage account. Is there any light that you can shed on the actual structure and how to be thinking about some of that stuff, broadly speaking?
The way that I would answer that question, and you'll see that there's a theme in the way that we run our firm here, is that what is the goal, right? And particularly, how old are you? And then what are the particular tax implications that you have in your life in terms of a traditional IRA versus a Roth IRA? And so when you start looking at the different vehicles that are available to you, first and foremost, what's the goal? What are we trying to do? What is it that you want to accomplish? And then in determining what it is that you want to accomplish, then you can look and see, am I in a position where a Roth IRA would really benefit me because I'm not going to owe anything to Uncle Sam. And so I'm in New Jersey, so you're not going to owe as much to Uncle Vinny. So, you know, at the end of the day, what your strategy is going to determine what vehicle you use. And let me just also say this to you. In terms of the engine inside of a Roth or the engine inside of the IRA or in your 401k, the title of that vehicle is basically the wrapper of a candy. And the candy itself is the actual investment. And how that wrapper is defined lets you helps you know what your tax implications are going to be. But the candy in and of itself, if I take a peppermint and I put it inside a Roth IRA, it's going to perform like a peppermint. If I take that peppermint and I put it inside a traditional IRA, it's going to perform like a peppermint. So that candy in and of itself is going to do the same thing, whether it's inside of a Roth, a traditional, or if you have the ability to do the same thing inside your 401k, it's going to perform the same way. It's the actual wrapper, right? What kind of wrapper is it in? Oh, this is the kind of tax implications that I'm going to have. This is the kind of tax implications that I'm going to have. This is how I'm going to be able to, you know, lower my taxable income if I do the 401k, if I do the IRA. I'm not going to be able to lower my income if I do the Roth IRA. But again, it's all going to be goal oriented, right? So we get this question often. You know, I heard that I should be in a Roth IRA. Okay, okay. Who told you that? Well, I was in the barbershop and Malik said that Roth IRAs are the thing to do. Well, all right. Well, Malik is in the barbershop, right? Where's his office? He don't have an office. Oh, okay. So do you mind if I give you a counter to Malik's suggestion? Because people get all passionate about well-intended but misguided information. And so what we want to say to you primarily is when you're looking at these different strategies, whatever it is, consider the source that might be telling you to do it, but then check it with someone that's in the field just to make sure that the wrapper is the right thing and the candy that's inside, it's the right kind of performance. All right. Does that answer that question, Anthony?
I think that was one of the best explanations of candy wrapper that I've ever heard.
And listen, if anybody's name is Malik, I'm sorry.
I know. I was gonna say Malik in the barbershop may not agree.
And Vinny from New Jersey.
Well, Uncle Vinny is like, hey, and since I don't go to the barbershop, I'm gonna pick on all the barbers.
Now, Kristen, question for you. What's the best strategy for investing in my 30s?
You asking because I'm in my 30s?
I don't know.
Well, let's see. That actually might be a better question for George, but I will say this. If you're in your 30s, you're far off from retirement, unless you're part of, the FIRE movement. I'll leave my comments on the FIRE movement to the side. I hear George talking, but he's muted, so I don't know what he's saying. I don't know if we're in agreement about the FIRE movement or not, but let's just say you are in your 30s and you plan to retire at retirement age. So, roughly 65 years old. You've got a solid 25 plus years that you're going to be able to save. So this is time for you to be able to get risky with your investments, right? This is not the time to say, I'm going to try to build my retirement nest egg with CDs, which I would honestly not even bother with if you're in your 30s, because it's not really going to yield you a pretty good return. And I would also stay away from doing things like, heavily loading up on bonds. This is time for you to be able to be more risky in your portfolio, do things like invest more in equities. Of course, we also have inflation, which is going to hit But just keep in mind that this is time for you to be able to take on risk. And it's also a time, as Carl was saying, we refer to him as the Oracle of Omaha, Warren Buffett, because he has really great investment advice. And the reason I'm about to say what I'm about to say is because we have huge recession risks. They say we're about to go into a recession next year. So a lot of people are going to get fearful. This is a time, if you're in your 30s and you don't have to pull out that money anytime soon, where you can afford to get greedy. When the markets go down, you need to consider it as your favorite dress, your favorite pair of shoes, whatever it is you want to buy, going on sale. And I love sales personally. So whenever I see the markets in the red, honestly, I get excited. I'm waiting for Amazon to tank because I'm trying to buy that stock. I don't want to spend, well, they're going to have a stock split, but let's just say they didn't. I don't want to spend $3,000 on Amazon. I want to spend $100 on Amazon. And so I need Amazon to come down. And so when I see the markets in the red, I'm excited and I'm going to buy down everything that I wanted to get involved in before. Now we do have fractional investing. So even if you couldn't afford to buy one whole share of a stock before, you could always buy a piece of a share, but this is really a good time for you to load up in your portfolio on things that you really want to get because they're on sale. And you have that time and that ability to do it. I would also suggest if you're younger and you're in your 30s, invest for your retirement. Invest for your retirement. I know it's a long way off, but you need to invest for your retirement. Most people undersave for their retirement. They think that they only need $500,000 because that's a lot of money for them to think about in their hands. You need to be thinking, honestly, 7 figures. If you want to live modestly, you need to start thinking you need a couple $1 million. You want to live more lavishly, you need tens of millions of dollars. You need a lot of money. So you need to start early. And I would also lastly say that you can invest for almost anything. You want to buy a house in 10 years? You can invest for that. You can literally have an investment account for that. You're 25 and you want to get married in 5 years? You can invest for that. You have a child and they're 2 weeks old? You can invest for their education now. They got a social security number, you can open up a 529 account. So I would say that when you are in your 30s, invest for literally everything that you can think of. Put all your money to, once you have those emergency savings, you already got your money's taken care of. You don't have debt. You don't have to worry about an emergency hitting you. You could start thinking about switching the amount of money you put in savings and the amount of money you put in investing, and start saying, I'm gonna put more into my investments and less into my savings because I'm already taken care of there.
Kristen, thank you so much. That was a great answer. I see Chuck Roberts' camera's on, so hand it off to Chuck. Make sure that we're all in compliance here.
Yeah, I'm going to say this to you, Anthony, and the rest of the panel here, George and Carl and Kristen. I couldn't have asked you guys to do better. I really could. I couldn't have written this out and come up with a better solution that you guys gave tonight. You were excellent, all of you, and I'm sure the audience agrees with me. I know Marvin does. I know we chatting back and forth about how good you guys were. I'm going to go to Wikipedia tomorrow and add another word that talks about superlative performance, and that's what you guys did tonight. Everybody that listened tonight should have walked away with several ideas of what to do next. I mean, go to the balance. Go log in, be a follower. Go start using their search engine. Go talk to people over at the companies that our panel members belong to. Hopefully we're giving you their email address. I don't know if Marvin, is that happening right now? I want everybody that actually is tuned in, all the people that came in. I do apologize for not handling the chat stuff, but quite honestly, it was going so extraordinarily well. I didn't want to jump in and drop a question which may have taken you off course, and that's blame me. I'll take the bad for that. But you will see another production of this through YouTube as I'm waiting for Marvin to chime in on me. We'll send out an email to everyone that actually registered, and anyone will also post it on our website on the nyblackmba.org website as to upcoming events as well as this event, so that you can go back, and if you didn't take notes, you're going to be able to take notes again. It was brilliant. It was brilliant. I thank you all. I don't know where to begin to thank you. I mean, check your investment portfolios tomorrow. You'll see a deposit made for me. I'm so glad that this all worked out. I mean, thank you. What I mean, how do we close this out with such a great event like we did tonight? I do want to say that again, that April is Financial Literacy Month. We have another session on Tuesday next week on the impact of inflation on the market and the economy. Please, if you follow this, we're trying to build your vocabulary on all these terms, which will in turn help you think about investing and help you think about what's going on around you so that we're not left out of the conversation, that we understand why inflation and why the Fed does what it does. We actually have a member from the Fed on our panel next week. That should be fun to explain how they come up with the things that they come up with. That should be very interesting for that point. But once again, I thank everyone involved here tonight. Our sponsors, the NASDAQ people, the people over at Prudential and Merrill Lynch and BNY Mellon and everybody and MBA Chic and the Balance, of course. Please, thank you again for joining us tonight. I think we're going to pause for a moment to once again make sure you do have those contact information from the three gentlemen here that actually do the investing, because I want you to follow up with them. Don't let this opportunity run away from you. This is a very important one. Thank you all. Thank you so much. We'll stay up on live so we can get you that information. Anybody have anything else to say to me?
I stole Kristen's idea. I saw her answering questions in the chat.
Yeah,
So then
yeah.
I started answering questions in the chat. So I was definitely a follower at that
Okay.
point. So we were getting to some of those answers. So I was like, she's not even paying attention. And then I saw.
And you notice
it's called millennial multitasking.
Yeah,
I
Kristen is
will
all
read
about
the
it.
chat.
Us old people have to learn how to follow the young people.
I'm with you on that. I know exactly. But you notice how the dog didn't even bother her? The dog just sat there and said, hey, I'll get a better treat.
Yeah.
I don't have a dog. It's too much. Like, increases my monthly expenses.
There you go. Good. All right.
I don't have kids, so he's my kid.
We got you.
I have it on good authority. He's a little bit cheaper than the human variety of children.
Amen to that.
As long as you don't call us dogs, we're fine.
There you go.
Unless they're a kid.
Yeah, Anthony, again, thank you, my brother. Hey, I owe you all a debt. Just call me, let me know when I can do something for you too as well, right? We have a virtual career fair on May 5th, and we're talking about 75% of the companies that are coming are Fortune 500, which says a lot. They all want to give to us in some way, shape, or form. We'll have several hundred people coming in there. I want you guys on the panel, please let people know that that's an opportunity for, once again, growth. Best way to, although we don't say you'll get rich by working, it's not a bad idea to double your salary if you can. Figure that out.
And income funds everything else that you do. All right.
That's right.
So there's no shame in having a job. It should just not be the only thing, the only source of money that you have.
Exactly right. Exactly. It gives you more money for investing, right?
100%.
Yeah. Wow, this was fun, guys. I really enjoyed this. Thank you so much. Thank you.
All right. Thank you all.
Thank you.
Hey.